For the better part of the last year, the market's been an absolute horror show. Blood and gore all over the place as the bears rampage and the bulls drown under a tide of red ink. But in the last month and a half, we've caught a stunning rebound, mostly because it's started to feel like the Federal Reserve can win its war against inflation without wrecking the entire economy. Now we need to ask ourselves one question. Can this rally off the lows keep going, or will the rug get yanked out from us again? Remember, we had a great run over the summer, too, before the whole move collapsed in the last 3 weeks of August. Back then, commodity prices peaked and plummeted from their highs, major victory in the fight against inflation. But in late August, Jay Powell crushed our hopes, making it clear that we were still looking at a series of supersized rate hikes. I think this time's a little different. We've made a lot more progress in containing inflation. The federal funds rate is already 150 basis points higher than it was in August. And we fixed most of our supply chain problems, which is causing a lot of inflation. And that is a major component of the problem all the way down the food chain. But it is tough to get a read on this environment, which is why I like to step back from my own judgment calls and try to be a little more, I don't know, let's just say detached, take a more quantitative approach. So tonight we're going off the charts with the help of Carolyn Boroden. She's a brilliant technician who's teaching at IM.Academy SFX. I know a mouthful. IM.Academy SFX. And she's teaching stocks and futures. It's a stock and futures academy. She thinks, and I didn't want to hear this from her, but we did over the weekend, got to get more cautious. So let's go over it first with the S&P. This is a daily chart of the S&P 500. Lately, this picture's been looking a lot better for the bulls, with some of the daily moving averages suddenly turning into a nice floor of support. Okay, remember, these are all the key ones. However, Boroden wants to give you a real big heads up because she sees the S&P approaching an important hurdle on the way up. And if it can't jump that hurdle, well, then she thinks we're headed down. Remember, Boroden likes to look at past swings and to give them security, then project them forwards in various permutations, sometimes one for one, sometimes through the prism of what's known as Fibonacci ratios. For whatever reason, these past swings do often tend to repeat themselves. There's no logical reason necessarily that I can think of why this would happen, but there's no denying the common pattern. In the case of the S&P 500, Boroden points out that from late 2021 through early January 2022, this thing put on a 539-point rally. There's your number, okay? If you look at the recent run off the October 13th lows, what happened? Well, the S&P put on a very similar rally. 542, 539. I mean, that's a rounding error, right? I mean, it's almost the exact same thing. Very similar in scale to last year's final leg. Again, however, what matters? It matters because when you look at a chart, many swings tend to be similar in size to past moves. Boroden says it's something important you need to keep an eye on. So I want you to remember this number, 539, 542. Why is it important? Well, look at what happened after the S&P peaked on January 4th. We got a nightmare decline. Index fell 1,327 points into last month's lows. I mean, this is horrendous. Boroden's not saying we're going to repeat that kind of meltdown, but it's not good when a rally runs out of steam. And she thinks there's a real possibility this one might be doing just that. Boroden's identified a couple of key resistance levels based on both her symmetry projections and her Fibonacci method. They give us a ceiling between 4031 and 4043. Okay, so we're right where it really matters. Now, last week the S&P tried and failed to break through the ceiling. Okay, and since then it's pulled back. Doesn't help that the ceiling of resistance is pretty close to the S&P's 200-day moving average. That's this one. Okay, you see the ceiling? That's the purple line. It also tends to act as a ceiling when you're coming in from underneath it. Boroden thinks that it gives you a good excuse to take profits. What's it all mean? She's not saying that the rally's toast, but Boroden says the S&P needs to clear this hurdle. It needs to break out above last week's high of 4034, or else we could be vulnerable to more downside. In short, she sees this as a make-or-break moment for the S&P 500, at least in the near term. I did not want to hear that, but it doesn't matter. Remember, I said this is a clinical way to look at the market. So what would be a more bullish chart right now? Let's switch it. I've been depressed enough already about what's happening in the NASDAQ. Here's a good NASDAQ chart. Check out the daily chart in Lululemon. Now, in Boroden's eyes, this is a much more compelling picture. You know I'm a huge fan of Lulu because it's an extremely well-run retailer with a loyal customer base. I've had them on a number of times. As for Boroden, she likes the chart because you can see a clear pattern of higher highs and higher lows in recent months. This is what we want. Plus, Lulu's trading above its 50-day and it's 200-day moving average. Okay, so we're good on that case. And something like that's a green light for chart watchers. Boroden follows a different traffic light, though. She likes to watch the 5-day and the 13-day exponential moving averages, EMA, very short term. When the 5-day goes above the 13-day, which is what happened here, that's her buy trigger. When it goes below, that's when you want to sell. Right now, Lulu's in buy mode. In Broden's eyes, these are ideal conditions to anticipate higher prices. Of course, Lululemon has its own hurdles to jump. It's got a ceiling of resistance, 376, 381 right there, okay? Starting above 13 points from where it's currently trading. As long as Lulu can clear this ceiling of resistance, clear this hurdle, next target, 454, which would represent a fantastic run. She says she likes Lulu's chart as long as it doesn't fall below its floor of support, which is at 340, and that's down nearly $25 from here. And by the way, I did a lot of work on Lulu before I came in, checked with a couple of analysts, checked with some store checks, and everything jives with what you see here. Finally, for a big picture bullish chart, I want you to take a gander at the Dow Jones Industrial Average ETF, symbol DIA. Unlike the S&P 500, the Dow has the same technical advantages we just saw with Lululemon, maybe a little less exaggerated. Boroden points to a clear pattern of higher highs and higher lows. See, we got this going for us here. While all the moving averages are on the side of the bulls, okay? Her only hesitation with the Dow is that she's waiting for a new buy signal. Here, she's watching a 30-minute chart. Can you imagine? Where each tick represents half an hour, waiting for that same exponential moving average crossover where the 5-period moving average goes above the 13-period one. That said, the Dow's done a good job of clearing these important hurdles. It's above the major ceilings of resistance. Boroden wouldn't be surprised to see the ETF go from 338 today to 358 in the not-too-distant future. Isn't that amazing how you'd think that this had to be in sync with the S&P? No, they're really diverging. Now, if you watch last night's show, you know that I am in agreement with her. This is where I've said you should be. Over and over and over again, make things, do stuff, return capital, pay dividend, profit. Dow's been the strongest of the major averages. I bet it stays that way through at least the end of the year. Tonight's negative action in a bunch of NASDAQ stocks, including some important cybersecurity names, only confirms again that the Dow Jones is the strongest of the indices. Here's the bottom line. The charts interpreted by Carolyn Boroden suggest that the S&P 500 could be due for some near-term turbulence if it can't break out above last week's highs. But there are still stocks she likes, Lululemon, and she likes the Dow Jones Industrial Average. Let's take some calls. Why don't we start with Russell in New Jersey? Russell.
Booyah, booyah, booyah. How you doing?
Well, I like that. A triple booyah. You can always use one of those on a tough day. What's going on?
Hey, I wanted to know what you thought about MAT, Mattel.
It has not been acting well, which bothers me. I know Hasbro's been very weak. The last quarter was not perfect, but we know that they've got a lot of big movies, a lot of entertainment in the pipe for next year. I think you wait till the end of the year and maybe pick some up. I'm not going to be aggressive on it right now because I did not love the last quarter, even though I think it's been a remarkable turn. Hey, how about Steve in California? Steve.
Hi, Jim. Listen,
Steve.
the question that I have is that in 1972, I made my first investment in the stock Chevron. I bought it because my grandfather worked for Chevron. It was called Standard Oil then for
Standard Oil of
43
California.
years.
Right.
Yeah. And over the years, I've accumulated the stock through dollar cost averaging. And so I'm sitting in a pretty large position right now. And I know it pays a good dividend, but do I keep it in that position or do I sell it and pay the long-term capital gains? What's your advice?
Well, okay, this is really important. You know, some of these stuff are tax accountant questions. I mean, you have to look at what you have versus the rest of your portfolio. I can only speak to the quality of Chevron. Mike Worth on our network on Friday morning. I think Chevron is a stock that should be owned. I cannot come up with a reason to sell it. Good yield, good buyback, fantastically well run. So my take is no. Your another take would be, well, wait a second, maybe the rates are going to go up, whatever. But I think Chevron's a great company. That's what I can attest to. Now, the charts, as interpreted by Carolyn Boroden, just the S&P 500 could be in for some near-term turbulence if it can't break out above last week's highs. Remember, it's struggling, it has been able to do that. Lululemon and the Dow Jones Industrial Average both look better. Much more Mad Money ahead tonight, including we got a call last night on a company called Dycom. And I didn't like the way that I didn't know it well enough. It bugged the heck out of me. So we worked all around the clock on this one, taking a closer look. and giving you let's say the investment case for it, then stop following the hard money. I'm really in one corner of the market that I think actually has a positive narrative base right here, right now. And of course, all your calls rapid fire to tonight's edition of the Lightning Round. So stay with Cramer.